Welcome to the daily update, where I'll go over the action in the market from Monday, November 25th, and we'll see how things look for Tuesday, November 26th. Well, so much for a below average volume day. Lots of news coming out over the weekend, lots of things happening that had more of an impact on the market, and we ended up having a real gap higher. We opened right at R3. Now, the pivot points for Monday's session were pretty close to each other because Friday's spread between the open, high, low, and close was not very wide. So it didn't take much to get to R3. We got above 6,000. Unfortunately, that set the high for the day. And we ended up retracing all the way back down to the unchanged level before we bounced back up. So yeah, we were positive and things are looking good, but we're seeing the mega caps not performing as well. We're seeing value outperforming growth. These are just some concerns right now, but when you take everything all together, we're looking quite positive. We're also in a period of positive seasonality. Okay, before I get into the video, there's a thing called the SPX Investing Program. And if you act right now, I'm having a special Black Friday sale. It's already free until the end of 2024. So if you take advantage of this sale, it'll still be free until the end of 2024. Isn't that interesting? Okay, you can take a link below this video that will take you to the website as well as to a video that talks more about the program. You can also email me. Over the weekend, I do a number of different videos. You have immediate access to those where I delay them being available on YouTube or Rumble. And this video, the daily video, it's available as soon as I get it prepared. It's not available until the market closes. So this video for Tuesday is available right when the market closes Tuesday. So feel free to check that out. All right. And the daily video, that's where everything flows into as far as my analysis and commentary. Yeah, I do longer videos. I show a lot of charts. I do weekly videos. Everything ties together into the daily video. Okay, let's go back and talk about what happened. We had a gap higher open. It was quite strong and it set the intraday high. It was at R3 at 6,019. So yeah, we have a new intraday all-time high, but we ended up giving a lot of that back. Then prices declined below 6,000. We did find some short-term support at R2 at 59.91. And then we declined below R1 at 59.80, but we found support at the unchanged level. And as I mentioned quite often, with these pivot points, either resistance levels to the upside or support levels to the downside, the unchanged levels kind of built in all the time. And we can see that. Sometimes it doesn't matter, but it did matter in Monday's session. And then prices were able to climb back above R1 and close slightly below R2. We were up 0.3% by the time we got done with things, and we were above average with volume. Now, this is a holiday shortened week. Thursday, the market will be closed. Friday will be an abbreviated session. We've got a load of economic reports coming out, especially on Wednesday, but also coming out in Tuesday's session. So we'll have to see. A lot of this was reaction to news that's coming out, and quite often, or how the market has been taking this is initially positive. We'll have to see if it switches over and looks more negative, but we might see volume actually dropping off. But it didn't in Monday's session, and we are positive in the short, intermediate, and long term, not necessarily looking extreme right now. I'll go through the charts and it's showing good momentum. We're a little bit concerned that growth is underperforming value. Interest rates really came down big time, and I'll talk about the reasons why for that. And geopolitically, there may be a ceasefire in the works between Hezbollah and Lebanon and Israel. And the market kind of likes that. That helped oil to actually drop. And a lot of the reports that are coming out have to do with the confirmations for the cabinet. Okay, so the market responded favorably when Trump came out and nominated Scott Bessent for Treasury Secretary. And the market sees him as being market friendly because he's a hedge fund manager and he's expressed his priority to advance the tax cut proposals that Trump wants to do, reducing the national debt, which of course every politician promises and then increases it, and cutting the federal budget to 3% of GDP, where right now it's between 6 and 7%, and then incrementally implementing tariffs. Now, tariffs are very controversial right now. Is that a good thing to do? And some news hit after the market closed and it was taking the futures down. Now the futures are starting to come back up. And again, I just try to look at these things for what they are, looking at the positive and negative sides, where most people like to have an opinion about it, where the critical thinking way is just to say, okay, here's the good parts, here are the bad parts. How's the market going to react to that? And then Israel and Hezbollah could be nearing a ceasefire agreement, but we've been here before, only to have things fall apart. And the Dow, mid caps and small caps did outperform, doing quite strong. And we're coming into that time of year, especially for the small caps and mid caps, where they tend to do better. Are they going to see more follow through here? And mega caps and growth continue to underperform. And we would like that to do better. We would like it to pick up at some point. That will really help the indexes to go up if we remain positive. And we do have a non-confirmed Hindenburg Omen. That was generated last week. We're waiting to see if another spike comes. Now, the perma bears are already declaring this as a full-on Hindenburg Omen. It's not. It has to be confirmed. This is just the initial part of this, or at least the perma bears that I kind of follow on the fringe a little bit. I look at their heading in their emails, and because I really don't have the time to waste listening to people that are wrong 70% of the time. Okay, on a short-term basis, we have our 20-period exponential moving average on the S&P itself, looking a little extreme, but it could still go further to the upside. The Williams percent are stochastics, and then the 20-period simple moving average. These are stocks inside of the S&P that are above their 20-period simple moving average. Intermediate term, we just have the Sean trend meter, and it's been on this list now for a few days. And then I did change this up a little bit, that the Fed has been coming in and cutting rates, but this concern that strong economic reports, and that's what I added here to the scenario, they are raising doubts about future rate cuts. In fact, the Fed may not be able to cut rates, and if we keep getting stronger than expected economic reports, there's going to be more talk that they may have to come in and actually raise rates. The dollar was down and interest rates were also down. We really dropped. We were at 4.41% after Friday. With the announcement of Scott Bessent for Treasury Secretary, we really came down. We ended up closing at 4.27% with the 10-year yield. And this is kind of interesting too, is that we're back to being inverted with both the 10 to the 3-month and the 10 to the 2. We'll have to see how long this stays this way, and I'll show you the chart of that. We've actually slipped back again with the 10 to the 2-year. We didn't change with sentiment. After Friday, we were at 61. After Monday, we're also at 61, which is positive and we've been going up with sentiment, so that's also more positive as far as the trend. We're still not trending with the condition as measured by the ADX, the average directional movement. We're below 20 in the short term. It's trying to turn up, but it has not crossed its moving average, seeing a little bit of a budge with the intermediate term, but we're positive. The green line is above the red line. So we do default to positive as far as direction is concerned. And with the up day, the bias is positive. And now the last 2, 3, 4 days taken together, especially if you go back to last Wednesday, when we saw some late day buying that I brought out in the weekly videos, that's when things kind of started to shift. And especially the latter part of last Wednesday, and then Thursday was good. Friday was kind of not really all that great, even though we did close up on the day. But our momentum is positive. Okay, so we didn't have any economic reports, so there's no charts to show you. Here's from Isabel Net, up 20% 2 years in a row, and that's, if things hold on to where we're at going into the end of the year, that looks like is what's going to happen. And That's why sometimes, you hear people saying, well, we were up 20% in 2023. There's no way we're going to be able to do that in 2024. And then the people are going to be saying, there's no way we can do that in 2025. That's applying logic on a human level. The stock market has its own logic and it can defy human logic all the time. That's what makes it really challenging. And that's why I look at so many different things to analyze where we're at. But it's no reason to be bearish I mean, how do you get further gains in the future? By already experiencing gains. And this just goes through the average, back to back after 20% gains. We're up 12.3% with the median at 12.8%. And we're higher 6 out of 8 times, and that's 75%. So it's not a given by any means, but positive price action tends to lead to more positive price action. Okay, this is equity positioning right now in stocks, and we're not up to this one standard deviation yet, but we are seeing an increase after it had been dropping back. And then we expect the relative performance of the Magnificent Seven against the rest of the S&P will narrow, and we're kind of seeing that right now. They're not the real leadership, at least at this time. Of course, a couple of days, and it would blow this whole theory right out of the water if some of the Magnificent Seven stocks really start coming in strong. But that can also be taken as positive. We like growth to outperform value, and in the bigger picture, it is. And I went over that over the weekend. And so that's still looking good. What I'm looking at here in the daily charts are just these subtle changes between the two. And in the short term, value has been outperforming growth. But in the bigger picture, growth is still outperforming value and looking quite good here. And so, at least according to Goldman Sachs, they are expecting the Magnificent Seven to have less of an impact. And we've already been seeing that. This chart is actually kind of outdated based on the analysis that I do in these videos. And then chart of the week. Well, I don't know. You can put anything as chart of the week. Total flows into the equity sector funds since the U.S. election. We see a lot of money going into financials, and they're doing quite well. Infrastructure, and these are just the different areas where money's been coming out of utilities, consumer goods. This would be more like staples, healthcare, real estate, more the defensive areas. And of course, interest rates have been going up, and so that's making real estate less attractive. Hedge funds and mutual funds have lifted exposure to equities. So this is just both of these are going up, and it just means they're getting more into stocks. Then the year-end return after rising 20% year to date, and we're up pretty much all the time. I wish they hadn't used the different color here. This makes it look like it's negative, but when we're pointing to the left like this, we were down in 1980, and then all the other years ended up being positive after we have a 20% year. Okay, I did spend a little bit of time on Twitter, and I think I found a couple of interesting charts here. We're keeping an eye on small caps. Now, I personally don't do this. I just watch the small caps to see how are they going to impact the S&P 500 and the total stock market. According to bar chart here, they're finally breaking out above this downward sloping trend line. Now, they still have a long ways to go to outperform the S&P 500, and that's what I went over the weekend. So they're asking here, is it finally time for small caps to shine? Well, they've asked that probably 6 times in the last year. Everybody has. And this would really help. This is a weekly chart. And if we actually are able to close above this trend line, and instead of this shoot up, give back, shoot up, give back type of an approach that's been happening, to see a close, this would be part of helping things for small caps. And then emerging markets, they're really underperforming right now. And I go through that also in the intermarket analysis video on the weekend. And this shows that US stocks are still really leading here. And this also pretty much confirms that US stocks are taking over the world and have been for quite a while now as a percentage of the global market cap. And Sentiment Trader has something interesting that we'll be keeping an eye on. This applies to the energy sector. It says it should be and historic. Isn't that how you do that in the real fancy way? Decoupling has emerged between the S&P 500 energy sector and crude oil prices. And you can see this where energy, it's been bouncing back lately, where oil is, and it's even down more now that it's dropping on news of this potential ceasefire. a scenario that has occurred only 10 times since 1986. Following the last notable divergence of this magnitude, the energy sector declined 10% over 2 weeks. So we're just going to be watching that and see if it actually plays out that way. And then the dollar index, which has just been on a tear lately, that's the green that you see right here, the greenback. And we're seeing now the 10-year yield has been falling. So these two tend to go more hand in hand with each other. Is the dollar going to come down, or are interest rates going to go up, or are we going to see a combination of the two here? And then in the long run, stock prices go up. This is why I'm not a perma bear. This is why I gleefully make fun of perma bears, because you go all the way back to 1824. Yeah, there's some really severe things like 1929. There's 1987, which you can barely see now here. There's even the whole 2022 and all of that stuff. Yeah, there are difficult times, and we play that side and we become more defensive during those times. And I'm a big believer in hedging so that you protect what you already have. But look at how this has gone up overall. This is why are people perma bears? I mean, what a despicable and sad way to live your life if you're always thinking things are going to fall apart. So anyway, that's where I come out. But there are times when we look at the downside, but most of the time stocks do go up. Okay, then Trump vows an additional 10% tariff on China and 25% on Canada and Mexico. And that's kind of what was hitting the waves after the market closed, was causing the futures to go down. Now they're coming back up. We'll see how this is all played out. And of course, everybody will be throwing around, this is good, this is bad. We just try to take it for what it is and say, okay, how's this going to impact the market? And then US equity sentiment indicator here, it just shot up really high. And we're getting a real high reading with this particular indicator right now. Okay, here's the intraday chart. You can see Friday's session was rather muted. This is what I'm talking about last Wednesday. Now, you could say here, even on Tuesday, we saw some good buying. So there were pockets here. Even back in Monday, we saw some that came right off the bat. But what really stuck out to me was this late day buying that came in, where the other ones, it happened earlier in the day. That's why we say the professionals closed the market. And then we were looking to gap higher, and there was this big battle going on last Thursday, and we finally were able to break to the upside. And then Friday was just kind of, oh, yeah, okay, I guess we'll go up again. And then we opened right at R3, and I made a post about this on the website right off the bat, and that set the high. Now, this is good that we were up, but the fact that we set the intraday all-time intraday high too, right at the open, and then gave it all a lot of that back. We came all the way back down to the unchanged level. That's a little bit concerning right now. So the strength that I would see in this would be once we got back to the support level at the unchanged level and we're able to go back above R1 and close slightly below R2. This is more of the strength in Monday's session, not the fact that we gapped higher and then came down. So it's still rather muted, but it is improving things, and we're still looking more positive. And then we were down just a little bit with the SPY in the initial overnight session, but now, as I said, we've been starting to bounce back up. And we were pretty much, we actually gapped higher Sunday afternoon or evening when the futures opened. That's this light blue area. We were able to hang on to that, and that's what, and we were really shooting up right at the open, and that's what led to the higher open, and then the give back, and then the bounce going into the close, and then seeing a bit of a pullback, at least. But the chart I was looking at has us pretty much unchanged. This is also a little bit of a concern, but not necessarily the end of the world, where we see the red line above the blue line. We want the blue line growth to be above the red line, and that's not what's been happening over the last few sessions. And this is also a bit of a concern. We've actually dropped below this low that was set back on Halloween with the growth to value ratio for the S&P, and we were down here. We want growth to be doing better, but it's not for right now. It doesn't mean the market's going to necessarily fall apart, but we typically want growth to outperform, and that really helps the indexes to do better. So end of day growth was barely up, where value was up pretty strong. It was about even for the mid caps, and growth was up less for the small caps. So looking at the growth to value for the small caps and looking at the ratio here, we're still in a downtrend, but are improving a bit. Also improving with the mid caps, even though we're in a downtrend, and pulling back, even though we're in an uptrend with S&P growth to value, looking at that ratio. Coming down a little bit further into the rainbow with the growth versus value ETF. But discretionary is doing really well right now. Even though staples were up, discretionary was up even more. And that really helped the ratio between the two go up. And that's more encouraging for the market. Large cap growth not setting an all-time high yet, but still looking pretty solid. And here is the condition of the trend. The ADX, the black line, it's underneath 20. So we're not trending. It's underneath the moving average. It's still weakening, but now it's trying to turn back up. So if it can get back above the moving average and get above 20, that would show a strengthening trend. And right now, the green line is going up as the red line is going down, so we default to positive. We're seeing a little bit more of a turn up here in the short term, not quite above its moving average yet, still below 20, but the green line is going up. So the short and intermediate term are positive, and possibly, if we see more follow through, starting to develop more of a trend that could be strengthening. And so much for my theory about being below average with volume. We were above average. As far as sentiment, here's a weekly chart of a composite. We're coming in at 80.41. We're not seeing anything extreme with the fear and greed index that we look at, but this one is showing that we're extreme positive. And then the insider transactions ratio coming down a little bit. These are legal insider transactions. And when we get this chart, I also show this chart. There's an insider buying ETF, just pretty much going sideways, not really seeing much of an advantage there. And I do go over this in Friday's video and then over the weekend. This is the spread between bulls and bears with the AAII, the individual investors, came down. But this is a week old now. And we were looking exhausted and we didn't see a lot of follow through to the upside. This spooked a lot of individual investors and their reading really came down. It's probably going to go up quite a bit in the next reading. And this is another area that's positive, but maybe a little too positive. I go over this in the weekly video. The spread between risky and not as risky bonds, it's getting very, very low. And I pointed this out last week too. This is really, really low, maybe too low, maybe too much complacency between the junk bond spreads. They're really, really low right now. And just to put it in a bit of different context, this is an inverted version where when this is going up, that means risk is really low. And we're getting a very, well, high reading here, which would be low if it was on a regular scale. And we did drop with the VIX with the line chart and the bar chart. We're dropping with the VIX of the VIX since we had an up day. And the momentum for the MACD after with the VIX as measured by the MACD was starting to come back up. Now that the VIX dropped and we're getting into the mid 14s now, it's turning the momentum back down, which is more positive for stocks. And that's typically what we see seasonally for the VIX, is that it goes down as stocks go up during this time of year. We're still getting even deeper into the red area here with the skew index. The market is still anticipating some kind of a big move that didn't seem to happen in Monday's session, so they're still expecting it yet to happen. And we really declined with this fear gauge as well as the other fear gauge. So we're seeing more confirmation. A lot of that has to do with interest rates coming down. We saw a drop off in the daily equity put call chart. So we're going down with the 5-day chart. We're also going back down with the 10-day chart. That's more positive. Volatility risk premium dropping here below the band. So not seeing an awful lot of fear there. And we're setting an all-time high with the advanced decline line based on price and volume. That is very healthy. Seeing a real expansion of the new highs, really no new lows, starting to turn back up with the 5-day and kind of flattening out here with the 10-day. But when you look at all the green versus all the red, we're looking pretty good, and we're seeing an expansion of the new highs. All right, we're coming down just a little bit, but we're still above the moving average here with accumulation distribution. So we are positive. And we're positive with the advanced decline ratio, both with the blue line and the red line, short and intermediate term, still showing more of an improvement here with the Chaikin money flow. So our second smart money indicator is looking more positive, coming down a little bit, but still going up overall with the Chaikin oscillator. So all three of our smart money all three of our smart money indicators continue to be positive. Okay, leveling off a little bit with the vortex, but the green line's still above the red line. And setting a new all-time high with the cumulative advanced decline line for the S&P based on price and really breaking out based on volume. And we can see the red line's actually going up just a little bit above the S&P as we're seeing the broader market slightly outperforming the S&P 500. And the cumulative advanced decline line for the NYSE is busting out an all-time high here, showing a lot of improvement with the regular NYSE advanced decline line. And when we break it out based on common stocks, setting a new all-time high, both based on price and volume. The other NYSE advanced decline line breaking out just a little bit here above the previous high. And seeing a real improvement with the advanced decline line studies with the NYSE common stock, the S&P mid caps, and small caps. Things are looking rather strong right now. Are they going to stay that way? Those stocks above their 20-period moving averages that are inside of the S&P getting above this 80 level now, which is considered an extreme reading. But at the same time, it can also show good short-term momentum. And we're really shooting up here with this other study. We broke above 70 on Friday. Now we're continuing to go above 80. So I mark 80 on this previous chart. The 70 and above, that's just showing good momentum on here. That's why I have the different levels on there. And we're improving with the 50, 100, and 200 period moving average studies of those stocks inside the S&P. And we were way, way above average here with volume. We're breaking out above this pivot point, this dashed line that's really hard to see here because they have a big P right there on the chart. But we did set an intraday all-time high, but not a closing high. And we're starting to look extreme with the 20-period exponential moving average on the S&P, improving with the 50 and 200. And above the midpoint here with the Stochk RSI, these are our short-term, very touchy indicators here, and they're not getting extreme yet, which you could take as, okay, maybe there's more room to run, or maybe they're picking out weakness here. We're coming down after being extreme with the Williams percent R, but it's still looking just barely extreme. Currently, going back up with the CCI 14 and the CCI 20. And the short-term stochastics rolling over after being extreme here, still going up and just starting to become extreme in the intermediate term and turning back positive in the long term. And the force index above the midpoint and positive. The condition of the short-term trend is measured by 20 periods here, where we're able to break above both the green line and the blue line here. That's going to help things improve as far as the condition of the trend. And we're well above the simple and exponential moving averages based on 20 periods. But if you can kind of see this, and I'll try to point this out again, we opened, we had a high, we had a low, and you can see the difference between the open on the left and the close on the right. Not that big of a difference there. We're above the midpoint. We got right up to the +3 channel with the standard deviations chart and then came back down off of that. And coming down a little bit, the balance of power picked up this gap higher open and then selling as the day ensued, but we're still positive with this. And the condition of the 50-period moving average, intermediate term, we were able to get back above the red line and the blue line here. But you can see this looks kind of like a doji here, where you open and close at just about the same place. That shows more indecisiveness. We'll be seeing if that turns into something. With the go, no-go system, though, we are still positive with the darker blue bars coming up well above the midpoint with the highest high value. The TTM squeeze, darker blue, that's positive. And actually declined a little bit, but still positive with the ease of movement. And the Arun finally woke up after taking a break there and is turning a little bit more positive. It's seeing a real increase in buyers and a decrease in sellers. And the S&P McClellan oscillator, not quite extreme right now, but really showing an improvement. So we're going back up with the summation index based on price and volume, above zero and going up with the NYSE McClellan oscillator. So turning up with the summation index based on price and volume for the NYSE. Swenlin trading oscillator above zero with price and volume. That's positive. And we're trying to turn back a little more positive with momentum. It's been getting whipped around quite a bit lately. Coming back up a bit with the PMO, but when we break it out based on price and volume, we're going above the moving averages. So we're getting a really strong reading right now with the PMOs that are rising. The buy signals are going up, and we're starting to go up with the PMOs that are above zero. We continue to be positive with the Elder's Impulse system, but again, we have this little doji looking candle from Monday's or bar from Monday's session. We are still positive with the parabolic SAR. The slope oscillator, after coming close to its moving average, is trying to turn back up now. The MACD showing an improvement here. So in the short term, we're seeing an improvement. We're also seeing an improvement in the intermediate term. And with the long-term oscillators, the Trix and KST, we never turn negative there. And we're still rolling over, though, with the Copic curve. It's not showing that much of an improvement. And the Sean trend meter has gone from this lighter green area to a little bit darker green area, looking rather extreme, but also showing good momentum. And the money flow is getting a quite high reading right now, also up slightly with the ultimate oscillator and positive. On balance volume is still looking quite positive too. Again, the Pring bottom fisher, again, would you call this a bottom? I don't know, but it's picking that up for some reason, and for the time being, it seems to be a legitimate signal. In the RSI intermediate term based on 14 periods and the short term based on 9, both are above 50 and advancing. That's positive there, above all the moving averages that I plot here. The bullish percent index is going up for the S&P, the NYSE, and the NASDAQ 100. I don't really have any support or resistance levels other than what I've already tried to point out here. I was mainly focusing on support levels with this section, and we're not really hitting any currently. So, looking at the trend based on the hike in ASHI, we are positive. We are positive with the KEGI, black and pointing up. We're positive with the Renko, but we're still looking negative here with the three-line break. It hasn't picked up all this change yet. Long term, and I added a line here at 400 with the 150 and 200 period moving average study. For a long time, I was using the 350 level, the red line. Well, I mean, we've spent most of 2024 above this 350 level. So now we'll be kind of keying in on 400, both with the 100 and 200 to see, is that going to, if we get up to that level, is that going to suggest we've gone too far, too fast, even in the long term? Okay, we are positive across the board with the Keller market model on all different time frames and indexes. We've switched over to positive in the short term with bonds. I mean, you have a day like it had on Monday, it's bound to do something where commodities are negative across the board and the dollar is positive across the board here. The only sectors that ended up being down were tech, and that was virtually unchanged, where energy got hit. We saw a real improvement with real estate. Discretionary has been doing quite well lately. And let's see, communication was up, but not as strong as what we've seen in the past. And so an awful lot of blue or green here. You get a gap higher like we saw, and you're going to see a whole lot of things going on. With Canada, it's joining in the party with the Dow setting an all-time high, above 6,000 with the S&P, above 19.1 and then 19.2 with the NASDAQ. Healthcare had a bullish MACD crossover. That's more defensive. The S&P set a new all-time high. Real estate getting a BPI cross above 70. So that's showing some improvement there. Discretionary crossing above 80 with the BPI. Canada with a 4-year high. The dollar still looking really solid here. Staples having a BPI cross back above 50 after it had dropped below. And discretionary has a BPI cross above 70. And then we saw a little bit of weakness going into the close where the NASDAQ got below 19,000, but then the euro is setting a 52-week low compared to the dollar, which depends on your perspective on that. And we're seeing the red line going a little bit above the S&P weighted version of the index as the broader market continues to outperform. And so I wanted to show this. This is the ratio between the weighted version and the equal weighted version. When this is going down, that means the weighted version of the S&P is underperforming. Where we had been kind of chopping our way higher, we're seeing kind of a shift in the overall climate. Transport set an all-time high here. After watching them go sideways for most of the year, setting an all-time high with the equal weight S&P, and now it's confirmed. After Friday, it was not, but the QQQ equal weight is setting an all-time high too. And the Dow setting an all-time high, looking positive, and we're positive with the Elder's Impulse system for the diamonds. Still hitting this pivot point here. This was overhead resistance for the NASDAQ. So we'll have to see if we're going to be able to get up above that in the short term anyway. Also hitting this upper resistance with this dashed line here with the NASDAQ 100. That set the high for the day. But we're still positive with the Elder's Impulse system when looking at the Qs. The momentum, though, for the NASDAQ 100 is still negative. Small caps. Okay, everybody seems to love small caps. Today, is that love going to continue as we're seeing things improve? Not as much of a pullback as what we've seen before. We'll see if there's more follow through now. And with the Russell 2000 small caps starting to get extreme with the RSI, looking good based on the chart, even though we closed well off the high here. And the momentum, though, as measured by the MACD for the small caps, is positive. We're positive with the Elder's Impulse system for the small caps. Mid caps also closing off of their high, but looking positive. Positive with the Elder's Impulse system. The Wilshire didn't quite set, it might be setting a new all-time high. I have to differentiate here, but looking really good from a broad market perspective, as is the total US stock ETF. Financial sector setting another new all-time high. Here, the FANG index was actually down and has been chopping sideways as the bigger companies are underperforming. This is Facebook, Apple, Amazon, Netflix, Google, Nvidia, and other stocks that make up this index. And we're still underneath this shorter term trend line, but above this longer term trend line with the FANG index. Setting an all-time high with the Dow, the transport. So this is a confirmation. The perma bears were just screaming about this, and they were, and it's legitimate, and there's something to it. But now they can't complain about it, so they'll find something else that's going to fall apart. And we're seeing a bit of a drop-off right now with the utilities. Apple was up 1.33%, breaking a little bit further above its 50-day moving average, where we were up 2.2% with Amazon. Meta was up over 1%, still below its 50-day moving average. Microsoft up about 0.5%, still battling around its 50 and 200-day moving average. And you see, we're getting kind of close. We're less than a point where we potentially could have a death cross here. Google was up 1.75%. It had come all the way down to its 200-day moving average and is now bouncing back up off of that. Nvidia was down over 4%, coming back down to its 50-day moving average. Tesla was down almost 4% after it's had a really good run lately. Netflix must have had a difficult weekend and coming off of all-time highs, but seeing some profit taking right now. This is another area I pointed out over the weekend. We've been watching this. Semiconductors have actually generated a death cross here. Now, it's not all that blatant, and we're going to need to see things improve. Now, we were up almost 1% with the semiconductors on Monday. We're going to have to break back above this to negate this death cross here. If we continue to drop off, that's a huge thing for the market. So we want to keep an eye on this. And we're seeing an improvement in the short term between US and world stocks, but still a deterioration in the longer term with the correlation. Oil is dropping down now that there's news of a potential ceasefire. And the dollar, it shows it up here, but actually declined. This is because it trades 24.6. So that's why it's showing it up. We were actually down below 107. Now we're getting back above 107. And we really dropped off with the 10-year yield. They liked who was announced for the nominee for Treasury Secretary. And we were up with the 10-year based on price. And we've gone back to being slightly inverted now with the 10 to the 2-year after it had gone back to being normal. And not really seeing much of an improvement here with the Qs to S&P when we look at our growth to value ratios, but discretionary to the S&P doing really well. But large cap growth is underperforming large cap value. So we're not looking as good with the large caps, but we're improving a lot here with the mid caps and the small caps. So what's our outlook for Tuesday? We are still positive and we're still in a longer term period of positive seasonality. Now the seasonality for Tuesday, nothing all that strong, but I'm looking at the bigger picture there. And we're going to get the FHFA Housing Price Index, the Case-Shiller Home Price Index, Consumer Confidence, as well as new home sales, and then all the geopolitical things. We'll see if singing Kumbaya together might be able to happen. Okay, so here is Tuesday. This is the long list for Wednesday because a lot of the things that usually come out on Thursday are going to be coming out on Wednesday. The market will be closed on Thursday, and then we're just going to get Chicago PMI in the abbreviated session on Friday. And so here is a look at what the previous readings were, and then looking at the whole week in total. This is what I'm talking about for seasonality. We're positive with the Dow, but we're just neutral to positive with the S&P and NASDAQ for November 26th. And then this is stocks do better under re-elected presidents early. Well, we kind of have a weird situation right now because we have a new president who was also a previous president. And the incumbent president was not reelected, but dropped out of the race only to be taken over by the vice president. I mean, it's just kind of crazy right now. So I'm not really sure what to put into all of this data for the time being. But looking between Thanksgiving and the Santa Claus rally starting the new year, we do see solid returns going back to 1950. We're up almost 80% of the time with an average win of 3.78%. But that doesn't mean always. We're still down 15 times with the negative return of 2.13%. And with the small caps, also tend to be more positive than negative, but not always, and not always having a positive return. So we want to be careful of that. This is what I'm talking about. We're kind of leveling off here as far as seasonality is concerned before we see a nice little thrust going into the end of the month. And then this is another new one that was posted, I believe, on Twitter. This is Stock Traders Almanac 1949 to 2023 against 2024. So this is the pink line here, purple, whatever color you want. That's how we've been performing, but this is the norms of how things have typically performed. The black line are all election years. Then we have the top first quarter of election years. That was red. We were following that for a while because when things break out of their historical norms, you got to look for something to compare it to. And then when the sitting president is running, well, that kind of ended differently. And then the blue line is the aggregate, where you take everything all together. Well, 2024 is leaving all of those in the dust right now. And we do see positive seasonality, according to Carson, going into the end of the month. But when you look at Tuesday in 2023, it was kind of a coin toss there with a slight positive bent in 2024. And then we're in that positive time, according to Tom Bowley. From now until the end of the month, we do see positive returns for the S&P based on his research. And then this is after the election, going into the end of the year. This is also after the election, as well as what happened in 2020 after the election. So what are the warning signs? We're still not full-blown positive with our oscillators, and the copy curve is still going down. But when you take everything together, we are seeing some improvements here. And the momentum for the NASDAQ 100 is also still negative. Now, doesn't mean it's going to stay that way necessarily, but it takes these oscillators longer to turn. They're not as fast as some of the other indicators that we look at. And we do have a non-confirmed Hindenburg omen, which is just a warning sign for right now, just something we're keeping an eye on. And then the positive thing is we've got a long list here. All of our smart money indicators are looking positive for right now. We're also positive with the S&P and NYSE McClellan oscillators and summation indexes, the Swenlin trading oscillator, the Vortex, both the 5 and 10-day equity put call ratios. Growth to value, it's not breaking down, but it's not outperforming right now. Where discretionary to staples is still looking pretty solid there. The advanced decline lines are looking good. Our moving average studies are quite positive, maybe a little too positive in the short term. The parabolic SAR, the bullish percent indexes for the S&P, NASDAQ, and NYSE are all going back up. Ease of movement, money flow, ultimate oscillator are positive. Then the financial sector is positive, setting another new all-time high. Here's the Hindenburg omen. If you haven't watched these videos before, these are some screenshots of the definition. And there are 3 criteria that need to be met. Unless you're a perma-bear, then you can kind of pick out whatever criteria seems to fit your scenario. But this is what's supposed to happen here. And then what stockcharts.com does is they have one indicator that takes all this criteria and puts it together. We did get a spike on November 20th. Now we have until December 19th to see if we're going to get another spike. And the more spikes we get, the more legitimate this signal may be, because we had a lot of spikes right before the COVID crash, and then we had a lot of spikes right before 2022. So, and then I've been hearing a little things here and there. Is 2024 turning out like the end of 2021? Well, okay, fine. We'll just have to see how it all plays out. Okay, so our conclusion. I haven't changed anything since Friday other than the date at the top. We are still positive, but we're not trending in the short and intermediate term. We do have positive seasonality in the bigger picture. We are positive in the short term, positive in the intermediate term. We are a little bit concerned that growth is underperforming, and we continue to be positive in the long term. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.